Hello legends, it's Guan here. Good to see you all here. Thanks for tuning in for today's video. We'll be looking at the battle of the century, value investing versus growth investing. In this video, I'll be covering three major aspects. Number one, definition of investment. Number two, the differing school of thoughts. Number three, summary. So, without further ado, let's get ready for a dive. Now, definition of investment. According to Cambridge Dictionary Online, it's an act of putting resources, or more specifically, money, into something that can generate profit or to get an advantage out of it. Now, let's look at value investing, the concept that is widely practiced in the industry. Let's do this by an example. Suppose there's a business that can generate $1 of profit every year from year 1 to year 5. And you're given the choice to buy this business at $5 today. You're now paying $5 today to acquire a cash generating asset that generates a total of $5 of profit for you in the future. Do you think this is a good deal? Make sure you comment down your thoughts below. Not at all. In fact, it could be said it's a lousy deal. The main concept here is that the future money is always less valuable than the present money. Put it simply, the $5 of profit that you get from the future is not worth $5 today because of this silent killer, inflation. Now, let's look at this using the return on investment formula. It's $5 total profit in the future minus $5 of initial cost divided by $5 initial cost. 0%. But what if you are given an option to buy the same business at $2 today? Suddenly, it looks like a good deal. You are paying $2 today to get $5 of profit in the future. This represents a return on investment of $5 total profit minus $2 initial cost divided by $2 initial cost, which you will get 150%. So all in all, the concept of investing or value investing is to buy an asset that can generate a profitable return that is greater than the price that you're paying today. Now, before we dive into the juicy part, be sure to smash the like button and subscribe. Now, the differing school of thoughts. Now, suppose you are given a choice to buy a business that can generate $1 of profit in year 1, $2 of profit in year 2, $3 of profit in year 3, and so on. Basically a $1 incremental in annual profit until year 5. The selling price of this business is $2 today. Would you buy it? Of course you take it. This is such a good deal. It's a business that can incrementally make more profit per annum. And you can buy it at such a cheap price. However, the caveat here is that assuming the business remains intact and unlikely to go bankrupt and unlikely to lose its competitive advantage, then the deal will be worthy. Now, let's take a look at another example. You are given a choice to buy a software tech business, a sexy business, with expected annual profit that looks like this. Year 1, $2 of losses. Year 2, $1 of loss. Year 3, 0 profit. Year 4, $8 profit. Year 5, $10 profit. And you are given a choice to buy this tech business at $5 today. Would you take it? This is the infamous growth investing conundrum. People invest in highly scalable company, oftentimes the tech company, to expect huge profits in the future once the business reaches a critical size and controls a huge market share. Case in point, just take a look at Amazon in the early 2000s. But going deeper into the core, this, in the end, is also an investment where you expect the company to produce a growing, profitable return that is greater than the price that you are paying today, regardless of the nature of the business. This is to say that value investing and growth investing are all meaningless differentiations. They are essentially the same fundamental concept. Paying a low enough price or a fair price to own an asset that can produce an increasingly profitable return that is greater than the price that you're paying today. However, the reality is that tech sector changes at the speed of light. No one can realistically predict the rate of change of technology development. Oftentimes, tech businesses need to scale faster and larger in order to control a huge market share for it to be profitable. Case in point, Netscape was a pioneer web browser back in the early 90s. Look what happened to it. Microsoft Internet Explorer basically punched Netscape out of business. And as a result, Netscape was out of business. Subsequently, Chrome browser took over the throne from Microsoft Internet Explorer afterwards. Therefore, this is to say that some tech companies may go out of business due to the failure in capturing huge market shares and the failure to innovate. Now, linking this back to the tech companies in the current stock market that we have today. Some tech companies may do well, some may not, due to the super fast changing nature of the sector. Hence, in the end of the day, it really depends on how well you can comprehend the tech businesses as well as its underlying sector. If you can't comprehend the tech behind them or the nature of the sector, chances are this may be bad investments for you. Now, summary. In a nutshell, value investing and growth investing are all practically meaningless differentiations. They are just essentially the same fundamental concept. Paying low enough price or a fair price to own an asset that can grow an increasingly profitable return. Another important tip for investors is spend the time to read and understand the businesses as well as its underlying sector. Now, here's a quote for you. Growing your circle of competence is the new way forward. Alright, that's it. Thanks for watching. I'll see you in the next one.